But then it cancels out. It means, doesn't it, that banks haven't really any money at all? Theoretically. Never mind theoretically. And if they haven't any money, where do they get their reserves of $249 million or thereabouts? I told you, that is money they have made. How? Well, when they lend your $100 to someone, they charge him interest. How much? It depends on the bank rate. Say 5.5%. That's their profit. Why is it my profit? Isn't it my money? It's the theory of banking practice that when I lend them my $100, why don't I charge them interest? You do. You don't say. How much? It depends on the bank rate. Say 0.5%. Grasping of me, rather? But that's only if you're not going to draw the money out again. But of course I'm going to draw it out again. If I hadn't wanted to draw it out again, I could have buried it in the garden, couldn't I? They wouldn't like you to draw it out again. Why not? If I keep it there, you say it's a liability. Wouldn't they be glad if I reduced their liabilities by removing it? No, because if you remove it, they can't lend it to anyone else. But if I wanted to remove it, they'd have to let me. Certainly. But suppose they've already lent it to another customer. Then they'll let you have someone else's money. But suppose he wants his too, and they've let me have it. You're being purposely obtuse. I think I'm being cute. What if everyone wanted their money at once? It's the theory of banking practice that they never would. So what banks bank on is not having to meet their commitments? I wouldn't say that. Naturally. Well, if there's nothing else you think you can tell me. Quite so. Now you can go off and open a banking account. Just one last question. Of course. Wouldn't I do better to go off and open up a bank?